This is the CRE Weekly Digest by Lightbox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Melissa Lewis with our experts Manus, Clancy, and Dianne Crocker. We're in week 4 of the conflict with Iran, and so far, CRE hasn't shown much of an impact. On the regulatory front, bank regulators are proposing lighter capital requirements for banks that could be a tailwind for CRE lending. The 10-year Treasury climbed to 4.38% in its largest monthly increase since October. And now there's speculation about real estate being the big winner if money pulls out of private credit. Manus, what do you think?
I think everything that you just said, Alyssa, is spot on. All those things are true. We will get into some of this shortly, that deal velocity continues to be strong. We're seeing loans continue to get made on speculative properties. We do see headlines which say CRE could be the safe harbor compared to private equity corporate lending. So all of that is true at the moment. But as I wrote in my commentary this week that you could find on LinkedIn, I feel like we've entered a very, very tenuous spot for CRE lending right now. And I'm going to walk through it, and I'm eager to hear Dianne's comments about this once I kind of run through it all. But the glass feels more half empty right now than half full. Historically, Dianne and I are both quite glass half full. We always think that the concerns over CRE are overblown, that the sky is falling narrative is prevalent but rarely comes true. And CRE tends to either muddle through or thrive. It doesn't really collapse, with the exception of office in recent years. So that's where we're coming from. But it does feel right now that we are towing the line to a very difficult stretch for CRE. And let's walk through it. Since the end of February, everybody knows this, the war in Iran has pushed oil prices up somewhere between 50 and 100%, depending on the day we're talking about. Oil had been under $70 a barrel for many years. It had been under 60 for certain stretches. And now we're oscillating between $90 and $120 a barrel. So now we're almost 4 weeks into this, and that's undeniable. This has resulted in the threat of higher inflation. And we know that higher oil prices don't just mean higher prices at the tank. They mean higher prices for anything that uses oil in its production, which is almost everything. Anything that uses fossil fuels, even things like fertilizer. People are saying fertilizer is going to become very, very expensive. So the yield on the 10-year is up about 40 basis points, from about 395 to about 335, 340. That is a direct cost to borrowers right now that they didn't see coming a month ago. And on the credit spread side, we are now probably 40, 50, 60 basis points wider than we were at the end of February. So when you add the 40 basis points of uptick in Treasury yields, and it's even more down the curve. If you're talking about the 2-year, you're talking 50 or 60 basis points. And if you're talking about another 50 or 60 basis points of spread widening, you're now at 100 basis points higher cost of capital than you saw in late February. And we haven't seen that leave a mark yet, but if this persists, it will leave a mark. And two things will be certain. One is property values will fall, the bid-ask spread between buyers and sellers will widen, and you will probably see a noticeable downdraft in transaction activity. And certainly that will take place if this war in Iran persists, and we're still talking about it at Memorial Day. The other part of it is, Dianne has mentioned this before, there was really extraordinarily high expectations for refinancings in 2026. People were talking about 20 or 25% upticks this year over last year. That can't happen if mortgage rates are 50 or 100 basis points higher for most of 2026 than they were in 2025. So we've entered the danger zone. I referenced Kenny Loggins and Top Gun in our write-up this week. I can't help those 1980s references in my write-ups, but it is a concern. And the longer the war goes on, the more likely you're going to start seeing some headlines that say transaction volume is down, refinancing volume is down. We're keeping our fingers crossed here at Lightbox, but I don't think I saw this going 4 weeks, and now we're at 4 weeks.
Yes, Manus, as you pointed out, this week's headlines, they're a real test for the optimists like us, and we are certainly in a difficult stretch. I agree, the wild card is the war and the bigger problems that could be triggered if oil prices get up as high as $125 a barrel or even more, then we have bigger problems. And it's a long list, as you mentioned. It hits consumer spending, it hits retail owners, hotels, operating costs for apartments, and opportunities for NOIs to really get hammered if oil prices stay high and it ripples through the economy. It could be a major tapping of the brakes for economic growth. But Manus, you might be too modest to mention it, so I will. And that is that you were featured in a timely Commercial Observer article this week on this very topic. The reporter was Patrick Sisson, and his article was about the impact of the Iran war on commercial real estate investment. And the point that you just made was there, which is, yes, the impact thus far has been relatively limited. But your quote was, we're seeing an uptick in transactions, a deeper, more diverse buying pool, and people putting money to work, deploying capital, not just the opportunistic buyers. So I agree. We put a lot of stock in that. I think that's a meaningful and positive development. But, can it continue? And you made a point at the end of the article that I also think bears repeating for our listeners, which is, maybe there's a sense that a repeated cycle of crises. We had COVID in 2020. We had Russia's invasion of Ukraine in 2022, the inflation spike that same year, the 2023 regional banking breakdown, last year's tariff wars. Do we have this kind of numbness to crisis? Are people more comfortable with being uncomfortable than they were pre-2020? I mean, maybe, but it's hard to ignore the long list of economic impacts that we could endure if we're still looking at these high oil prices, as you said, come Memorial Day.
Yeah, we really spent about 10 years with people saying it's the great financial crisis all over again. Whenever something terrible happened, when COVID happened, or when Silicon Valley Bank failed. We're hearing it again right now with the woes on the private equity side. People saying that this is going to lead to big losses for PE firms, that's going to roll up to banks, and there's going to be bank failures, and the liquidity will disappear. And I do think the fact that people have been calling it the Big Short 2 or the Great Financial Crisis 2 for a long time, with many events, including Ukraine, like you said, that has never come to pass, has made people perhaps a little complacent now. But the point I would make, and you know this as well as anybody, is that a lot of the headlines we're seeing now are deals that had been in the hopper for 2 or 3 months, that they were so far along that there was no chance that these were going to fall apart. What really becomes concerning is next month and the month after. If we start hearing stories about lenders retrading, they've locked in loans with low rates, but they want to renegotiate, deals falling apart, buyers walking away, deal velocity slowing down. It's really that April-May timeframe that you would see this, I think, for the first time. A lot of this stuff, and there's plentiful headlines. We're going to talk about a lot of this over the next 30 minutes, that the deal velocity remains really strong, and the number of 9-figure deals that we're seeing is elevated, but that could turn on a dime in April, and it's certainly something we're watching very closely.
Yeah, definitely. And two things I want to mention on the more kind of positive side of the ledger, or the glass half full, to use that analogy. There are two. One was a point that Dianne made at CNBC in a piece that I know you saw, Manus. And her point was that there's a real case to be made, and she did a great job laying it out, that volatility in private credit could actually benefit commercial real estate, and that we're already starting to see early signs of capital rotating, fundraising into real estate vehicles like like non-traded REITs, they've been picking up after a pretty quiet period. And we know that if investors get uneasy about private credit or the broader market volatility that you just mentioned, whether it's tariffs or rates or the war in Iran, then they start to look for diversification. And here's real estate as a durable asset with income that becomes relatively more attractive to investors. So yes, we'll be watching the data, whether it's the transaction tracker data on deals from your team or the commercial real estate activity index, which is an early indicator of CRE momentum, because that will really be our first sign of whether the deal-making climate starts to slow down in March, April, and even beyond that.
You make an incredibly important point that I think needs to be underscored, and that is the problems that we are anticipating in CRE are not fundamental. This is not about rents. This is not about supply. This is not about CRE as an asset class. I think everything you're saying is spot on. All the things, the steadiness, the boringness, the predictability. If we're going to see problems in CRE, it will be completely a function of the war and the higher cost of funding and nothing more. And I believe that once that is over and we get that snapback of lower oil prices, the concern is gone. I do think that we pick up right where we left off. The only question is, I don't think anybody saw this going 4 days, and now we're at 4 weeks. If this becomes 4 months, then 2026 will disappoint on the velocity side, but it isn't a fundamental problem. But I do want to bring up something, Dianne, and it's another thing I'd love to get your thoughts on. I'm going to put this in the category of imploring. I'm imploring the Fed, to the extent that they listen to our podcast. I've been seeing a lot of chatter that at the beginning of the year, people were predicting 2 rate cuts. And now we're starting to see chatter that the Fed might go wobbly, that they might raise rates as their next move. And as a reflection of higher CPI that is driven by higher oil costs, that they will be tempted to raise interest rates. And with all due respect to the Fed members, that would be the most harebrained policy move that could possibly take place. You raise interest rates when the U.S. economy is overheating, when the punch bowl is out, people are getting euphoric, and things are really getting nutty. A higher CPI driven by higher oil prices. Higher oil prices is basically like a tax. You've already slowed down the economy. You've already anchored or weighted down the U.S. consumer with higher costs. To even consider raising interest rates at a time where the U.S. residential housing market is in the doldrums, when the job markets is uncertain, and when people are paying an incredibly high oil tax right now, and I'm going to use the term again, it would be the most harebrained Fed move in decades to raise interest rates at a time when the headwinds facing the U.S. consumer are running at 60 miles an hour.
Harebrained is a good word for it. And I haven't gone there in my thinking, I have to say, and it could just be that I just can't even wrap my head around the fact that rates could go up when everybody was forecasting 2 or 3 this year. I think it's obviously it becomes much harder for the Fed to lower rates if we're starting to see very real inflationary pressures as the higher oil prices kind of trickle their way through the data sets. But an interest rate increase it's hard to wrap my head around. And we all know that Trump's been pestering Chair Powell to lower rates, and Powell's term is ending in 2 months. And I think there'll be pressure on his successor to lower rates. I don't see a rate increase. I agree with you that that would be a very bad thing, especially if prices are going up and the labor market is weakening. I will throw out one more thing that I don't think we've talked about yet on the pod, Manus. And this is another tailwind in the lending space, which is that last week the big story was the proposal by bank regulators, the Fed, the FDIC, the OCC, that would allow the largest banks to hold 2.4% less capital. And that amounts to about $20 billion below current requirements against their assets. So that could be a significant tailwind. And it really comes at a time when banks have spent the better part of the last few years cleaning up their balance sheets, getting more comfortable extending debt capital again. And if this moves forward, it could also shift the competitive balance between the non-bank lenders that have been pretty aggressive in recent years, stealing market share away from traditional banks. So that's something the MBA is forecasting, a 27% increase in commercial real estate lending in 2026. It's largely driven by the wave of refis, but also higher origination. So if that's a tailwind, that 27% could increase.
And it couldn't come at a better time, honestly, because we don't know if PE firms will become more cautious or more limited because of their problems on the corporate loan side. Yes, it's two different markets, corporate loans versus CRE. There's two different arms of each PE firm that makes lending, but they do rely on warehouses in many cases. And if those warehouses become more stringently observed by banks, or the conditions change where banks are not putting out warehouses as easily, or the limitations on sizes and so forth get pulled in, that would remove PE's ability to lend in CRE as actively as they've been. We don't know if that will happen, but a nice offset to that, should it happen, would be banks filling in that void with lower capital requirements. So let's keep our fingers crossed.
Manus, before we go on, I wanted to mention another story that caught my eye this week. It was written by a friend of ours and a former guest on this podcast, Shlomo Chop. And the article's title was New Graves to Dance On. And it was really interesting because he built on Sam Zell's philosophy that it's the distressed cycles where investors have the opportunity to rush in when others are rushing out and to resurrect dead properties. And the point that Shlomo makes in the article was that it's different now and that that old playbook doesn't apply. And his reasoning is that the business models of the tenants inside buildings are changing too fast. So if you're an investor or an operator or owner, you can't keep underwriting like it's 1984. So there's your seed, Manus, for some like 1980s song reference. But his point was that real estate's only as durable as its tenants, so investors need to evaluate properties more kind of through the lens of an operating business and less like a perpetual bond.
It was a terrific piece, I agree. And he talks a lot about looking over the horizon when you're buying a property, even if you have a tenant in place with 6 years left on the lease. The question has to go through your mind, is that tenant going to continue to need this space 6 years from now? Or will they be locating to the Sun Belt? Or will conditions change that they need half the space that they needed before? And it's really well thought out, the whole thesis that now more than ever, a buyer, a lender has to look over the horizon and say, how quickly will this property become obsolete? And I thought the piece was very timely and it's worth picking up. I know that if you ping Shlomo on LinkedIn, he's constantly putting out material on LinkedIn. I'm sure you can get the piece from him. It's a great read.
Yeah, very prolific. We should have him back on the pod soon.
Dianne, let's turn to our Lightbox data dive. What do you have for us this week?
All right, Alyssa. Well, partly because we're closing in on the end of Q1 and I'm waiting to see what March data tells us about the market, I took a big pivot here and walked through the history books. Kudos to my colleague Richard White in Lightbox's Shelton, Connecticut office for this one. And the data number this week is 2,800. That's how many abandoned airfields across the U.S. are now in a data set that Richard just added. Richard's terrific. He is always in hunt and gather mode for data sets. He heard about this database on historic airfields at a conference panel when speaker Hope Klein at AEI Consultants mentioned it. And within weeks, his team got this database incorporated into our Lightbox collection. And some of the history is really cool. There was one record in that database for Roosevelt Field, an airfield on Long Island where Charles Lindbergh took off for his historic transatlantic flight. That property is now a shopping mall. And it occurred to me that as properties get repurposed, a lot of the headlines we talk about here, Manus, some of the past operations carry environmental risks and they can get lost. So historic databases like this are important because they make it easier for environmental due diligence consultants to come in, they do their detective work, and then they're better positioned to help lenders and investors go into deals with eyes wide open.
It's interesting that you bring this up because it brings to mind a story that's about 15 years old for me, and I haven't thought about it in about 14 years. I think it was in 2012, I took two of my boys to an outdoor music festival in New Jersey. It was at a place called Bader Field, if I'm not mistaken, near Atlantic City, where Dave Matthews was having a 3-day festival. And so for 3 days, we were traipsing around this abandoned airfield in southern New Jersey. And the environmental impact for us was felt because there was so much like black tar and decaying runway in the field where we were all watching this great music that at the end of each day, you felt like you needed to take steel wool to scrape the soot off your shins. And it would take like 15 minutes. It was like rubberized and it was hard. And you really had to, like, if it wasn't steel wool, it was like a chisel. And so I kind of get this whole thing in a way that maybe the average person didn't, that we came home thinking like we spent the weekend in a coal mine, not in an open field.
Very true. I love that you have a story for anything that we throw at you, and so many of them are about concerts.
As my wife will say, I have the mind of a 14-year-old and I grasp onto every trivial thing in my life, but I'll forget the most important things. So, which I think is 100% true.
All right. Dianne, time for our Did You Know for the week.
Okay, Alyssa, for the Did You Know, I turned back to the NCAA Sweet 16. We have the teams in the midst of their final games as we pull this week's podcast together. And as we mentioned last week, we're having a little fun with the data for these 16 college and university cities and towns. So looking at year-over-year growth in commercial property listings, and thanks to Quinn Overson for these, the standout markets and teams are Arizona. They're up 29% year-over-year in the first quarter. Houston is up 18%, and Knoxville, where property listings have more than doubled. So today we're coming out with our round of predictions based on a mix of Lightbox data. So we'll see how our predictions hold up. And by the way, Manus, I am doing terribly in the Lightbox NCAA pool, so I'm really not sure I should be predicting anything. How's yours standing?
I think that I'm bringing up the rear in some capacity. I may not be last, but I am probably in the lowest quartile. But I have to say, I mentioned last week my team is St. John's, and they've moved on to the Sweet 16 for the first time in 25 years or so. And they did it in thrilling fashion. For those that watched the game, it came down to the last second, and they scored a hoop to take down Kansas. And now they have Duke on Friday. And I have to say, my pulse has been elevated since Sunday afternoon, and I can't wait to see that St. John's Duke game. I'm really rooting for my Red Storm.
So great. These are great games.
All right, let's jump into the deals that caught your attention this week, starting with industrial.
We have an awful lot of industrial this week. We usually try to give one or two stories per category, but we might spend a little bit more time on industrial this week because it has been really a banner week in terms of headlines. And I'll kick it off. I'll try to go through these quickly. The first one in Southern California, a 17-property industrial portfolio, which includes some office and R&D space in the town of Goleta, sold for $235 million. The buyer there, Irvine-based Pralium, This is really a recap, not a straight purchase. They are recapitalizing the property from Majestic Asset Management, spending $235 million on that recapitalization. Reporting there by Claudia Tiganescu of Commercial Property Executive. The second story, another big one, EQT buying 2 million square feet of industrial space in southern New Jersey. Sales price not disclosed on that one, but it's along that I-95, 295 corridor. It's a mix of light industrial and bulk warehousing. And another big sale, 2 million square feet taken on by EQT. In a more national story, this again comes from Claudia Tiganescu of Commercial Property Executive. Ares is eyeing a 7.3 million square foot industrial portfolio acquisition. They expect to pay $650 million for this particular asset or set of assets. The financing will come from Wells Fargo, Barclays, and Bank of America via a CMBS loan. The portfolio has 36 properties spread across 13 states and 18 markets. This one is noteworthy because we're always worried about this PE story. Ares is one of the biggest PE players, and we worry about the corporate loan problems spinning over into CRE and reducing the PE appetite for properties. In this case, Ares spending $650 million, certainly not a slowdown of their appetite, at least at the moment, for CRE assets. We feel good about that. In Chicago, DRE dropped $200 million on Chicago area properties. The seller there was Venture One Real Estate. Venture One spent 3 years putting together a 32-building portfolio. They spent $150 million on that portfolio. They're now selling it to DRA for $200 million, so a nice 33% return on that assemblage. Reporting there by Emma Whalen of The Real Deal. And lastly, a real big one here. This is in the self-storage market. Some people consider self-storage its own market. Some people call it a sub-segment of industrial. I'll let you guys decide which you prefer. But the story here, Public Storage paying $10.5 billion to acquire National Storage Affiliates. So this is a corporate acquisition. The $10.5 billion price includes the assumption of some debt there. But listen to these numbers, 555,000 units as part of this sale. And for the math, for people who want to know out there, that translates to about $19,000 per unit. So a big portfolio to digest for Public Storage.
Manus, that is an incredible mix of industrial deals, especially on the portfolio side. And I'm envisioning when I get your data set for March deals from your team, the transaction tracker report will need to have a special carve out just for all these exciting deals happening on the industrial front, where in the past couple months, it's mostly been about multifamily and retail. It's great to see.
That industrial market, it's the rally that never ends, really. It started in 2015. You probably remember back then, you'd see industrial properties selling for $50 a square foot. Now they sell for $350 a square foot. And periodically over the last 6 months, we've seen some indications that perhaps the trade is getting tired, that some big owners are starting to sell properties, that we're starting to see a leveling off of rent increases, growth. We're seeing a little bit of negative absorption. That was a headline last week in South Florida. And yet, every time we see one of those headlines, it seems to be followed up with a week of just explosive sales volume. So may that 11-year rally continue to a 15-year rally or 20-year rally. It's been the rally that never ends.
Yeah.
Okay, let's pivot from acquisitions to what's getting built next. Moving on to development. Manus?
So it's important to preface this with something I said a few minutes ago, which was deals that were in the works in January were not likely to get the rug pulled out from under them in March because of the war. That will come a little bit later if people start to retrade their deals. We can get into more of that if time permits. So a lot of these deals that I'm going to talk about underscore capital availability for capital intensive projects. We love this because when you see this, you know that liquidity is out there, that the first thing to go in a downturn is access to capital for capital intensive projects. The fact that we're still seeing these types of headlines is positive, but it comes with the caveat that we may not see these things continue as often as we've seen them over the last 6 months, should that war in Iran continue. But here goes. The first one comes from New York City. Quantum Pacific has landed a big construction bridge loan for 845 3rd Avenue. That property in Midtown Manhattan is slated for a conversion. It will be converted from office to a 529 unit apartment complex. Financing there provided by Bank Hapo Elam. I think that's the first time we've referred to that particular institution. Our second one is Kane received a $4 billion financing for a One Beverly Hills mega project. This is slated to be an Aman branded hotel, along with luxury condos and some retail. The funding there comes in two parts. The big senior loan coming from JP Morgan, the mezz loan, which is $1.5 billion, coming from Vici Properties. So two particular assets here, capital intensive, people either developing from the ground up or converting, getting 9 or in the latter case, 12-figure debt to see their project through. And we saw one more headline, which is of a piece of the first two. This comes from Globe Street's Anthony Russo. He cites a Cushman and Wakefield report. The headline, Manhattan office conversions to double in 2026 after a record year in 2025. And that's really undeniable, Dianne. Every week we see another headline or three which says, this property in Midtown, this property in Soho, this property in the financial district being converted from Class B office into luxury housing. So we were skeptical, I guess, a little bit that this would take place, 2 years ago, just because it is so capital intensive and not all properties are really suitable to be converted from office to hotel or office to residential. But developers are figuring it out. And a lot of that is happening in Manhattan.
Yeah, I agree that, it was an interesting headline and it wasn't one that was very surprising given a lot of the stories that we've highlighted here, even over the past months and even past year. Not surprised at all that Midtown is leading the way and that the headlines aren't just about obsolete office, but they're about fearless, intrepid investors coming in and taking on these conversions, which, like you said, are very capital intensive. But it, kind of strikes me as like kind of a flywheel. As more and more deals happened, it gave others the courage and creativity to jump in and do the same.
Before we wrap, let's get into our slice of life. March Madness is in full swing. So Manus, Dianne, what's your favorite March Madness memory? Dianne, why don't we start with you?
Well, I love this tournament. I always have. It was a big, big part of my childhood. My dad is very top of mind this week. He was an extremely enthusiastic UConn Huskies fan, especially in the great days of Coach Calhoun. And many's the time that I would watch games with him. He'd be on his feet, yelling at Calhoun, clapping like he was in the stands, yelling, so Friday night, I will be wearing his UConn t-shirt as I watch his Huskies advance to the Elite Eight, and then again when they make it into the Final Four. How about you, Manus?
Oh, Dianne, those are fighting words. If they get to the Final Four, they have to go potentially through St. John's. I think that you and I will have to avoid emailing or texting each other should that game become a reality. But my story is very much like yours. My father went to St. John's in the 1950s. I'm not sure there were too many bigger fans than he was, and just so many Saturday afternoons sitting on the couch with my dad in his recliner with his feet up, watching the Red Storm and Lou Carnesecca. And, he started taking me to games in the early 70s. And If we were in the car, the radio was on, we'd be listening to St. John's play St. Bonaventure or South Carolina. And it was just wonderful family time. We all just would watch the game, my brothers and sisters together. It was really family bonding. And even now, when the team plays on Friday night, my two sisters and my brother and I will be texting like mad to each other just about the game. You'd be hard pressed to find four bigger fans than the four of us these days. So it's all about the family, and I love that part of it.
Me too. Well said.
And with that, we'll close. Thank you to our producers at Bruning Media. Be sure to join us each week as we break down CRE news and data in context. You can listen on all your favorite podcast platforms and send your comments or questions to podcast@lightboxre.com. As always, thank you for listening and have a great weekend.
Let's go.